now, on the Money Watch, you've probably heard that you should never take money out of your 401k early. But there are some times when you are allowed to break the rules. Certified Financial Planner Joe Bert is here to explain them to you. Good morning, Joe.
Good morning, Tom.
All right, so let's start off with educational expenses. This is one of the biggies.
Yeah, what we're talking about here is when you can take from your, allowed to take from your 401k, and it's what we call hardship withdrawals.
Okay.
First of all, your plan has to have that provision in there. Not all plans have that in there.
So you need to read very carefully before you think about doing this.
Right, and this is different than taking a loan. This is actually taking the money out. You're going to be subject to tax and a 10% penalty if you're under 59.5. So here's give me the first one.
All right, educational expenses.
Yes, if you need to pay the tuition for yourself or a spouse or a dependent, you may be allowed to take money out of your 401k, pay the taxes, and the 10% penalty.
Now, does this include the secondary education?
Yes.
Is it college?
It's college expenses.
It's college expenses. Okay.
That's correct.
All right, buying a home.
Buying a home. Once again, you may be allowed to take money out as a down payment on the home. The better way to do this, if you need some money, is perhaps if you have an IRA, you can take money out of an IRA and avoid the 10% penalty.
Okay.
Once again, everything we're talking about, you have to pay taxes, and in some cases, a 10% penalty if you take it out of the 401k. Take it out of the IRA, you can take $10,000 out without the penalty.
Okay, what about home repairs? This is something with real estate the way it's been the last 10 years. A lot of people are doing now is fixing their own.
Now this isn't remodeling the kitchen or putting in the pool. This is for casualty losses. In other words, your house is flooded.
So this is when you have to, not because you want to.
The storm came in, blew the roof off, things are falling apart. This is for those kinds of hardship situations. It's not because you need that new screen enclosure.
Right. What about foreclosure?
Well, if you're in the risk of losing your home, but it doesn't mean that you're 1 or 2 months behind in your mortgage payments. If you got that foreclosure notice, and if your plan allows a hardship withdrawal, you may be able to withdraw from your account and use it to pay your mortgage.
Medical care?
Medical care, once again, to pay for medical care for yourself, your spouse, or your dependent, you can withdraw from your 401k if the plan allows it.
What about a death in the family?
You can use them. You can use the funds for that, for the burial expenses, but you can't use it for the reception afterwards. It's all for the funeral costs, for the burial costs, and you can't use it for flowers. All that, direct expenses, exactly.
And again, though, you have to remember taxes and penalty, right?
Yeah, if you're under 59.5, you're going to have a 10% penalty. Okay. And you're also going to pay taxes in all cases.
How quickly are those things due? Is it for the taxes, the next tax?
The next year. Yeah, it'll be something. You'll get a 1099, not pay taxes on it the next tax year. Once again, not all plans allow it. And the better way to do this, if your plan allows it, many more plans do allow this, is to borrow from your 401k as opposed to making withdrawal.
And pay it back.
Because if you borrow, you're paying yourself back.
Right.
You're acting as your own bank. Not all plans allow that, but if it does, I think it's a better way to go.
All right, Joe, thanks for explaining.
All right, Tom, good to be here.
Have a good day.